country's largest bank, State Bank of India, reported a beat in terms of asset quality. Asset quality was far better than expectations on most fronts, and in fact, quite a lot of the brokerages have now gone ahead and upgraded the target price. The target price stands anywhere between 450 rupees to 650 rupees per share. And if you look at the current market price, it's a significant premium or significant upside rather, as the CMP now stands at nearly around 400 rupees per share. In fact, just quickly post the results, the stock did zoom nearly around 5% in trade immediately post the results, and the stock has already been up close to around 9% just prior to the results in the month of May. We're seeing that the SBI Gross and Net NPA are the lowest in the last 5 years, and they did do a very strong show even in terms of the overall operating performance. As per the latest Morgan Stanley report, SBI Gross and Net slippages have been similar or better than those of the large private sector peers. SBI gross impaired loan formation stands at 2.3%. This is fairly similar to HDFC Bank gross loan formation at 2.3% for the entire fiscal 21. In terms of the net impaired loan formation, SBI ratio stands at 1.6%, while HDFC Bank ratio stands at 1.8%. So from a net loan formation perspective, SBI is far better than all the large private sector peers itself. In fact, if you look at the brokerages, well, GOLDMAN has gone ahead and upgraded the target price for State Bank of India. GOLDMAN does state that they maintain a buy with the target at 648. They are positively surprised on in terms of the entire FY21 on many counts, and they do state that improvement in ROA is on the back of expanding retail portfolio. They do see peak ROAs of 1% and ROE of 16 to 18% by FY23-25. CLSA maintains a buy. They've gone ahead and upped the target price at 650 rupees per share. They do state that Q4 was a significant beat. Further, net interest margin has the net interest margins rather have improved further. FY21 slippages at less than 1.2% of the loans were the best in class. Corporate credit cycle is turning and retail slippages are less than 0.5%. The conservative expect SBI ROE to inch up about 15% by FY23. They also mentioned that the current valuations at 0.7x March 23 book are fairly undemanding. JP Morgan maintains overweight with the target of 500 per share. They do state that SBI's FY21 asset quality is even better versus the large private banks, and they expect banks' ROA to reflate back to the historical average. However, the credit growth was slightly hazy. Morgan Stanley maintains an overweight with a target of 600, and Macquarie maintains an outperform with a target of 450 rupees per share. In fact, SBI, while in an exclusive interview to ET Now, SBI's Dinesh Khara, who's chairman of State Bank of India, did state that they are expecting recovery in activity in the next 2 to 3 months, and vaccination holds the key. They are comfortable on the capital position, and they expect internal accruals to take care of requirements. They also mentioned that the intensity of the second wave is high. However, they did not give any guidance. However, they did mention that they would try and strive to maintain the asset quality trends. And on the growth front, they did state that they may see robust credit growth once COVID is behind, and if the economy improves, they would be happy with the credit growth of nearly around 10%. So yes, watch out for State Bank of India in today's trade.